I'm Mike Chabalik. Pleasure to be here. Hopefully the career fair is going well for you guys. I'll try to make this as relevant as possible to you guys. I've had the pleasure of coming into Rochester Works for the last 11 years, so I do a lot of work with people in transition. And the way that actually happened was that my father-in-law went through a layoff from Xerox. And so at the time when he went through the layoff, he was 52. So he had a bunch of different things to face that normally you wouldn't have to face at that age, such as leveraging his retirement accounts to live off of, healthcare expenses because retiree health insurance wasn't there yet because of his age, the overall shock of a job change. That was another big thing that was just, he was used to being at one company for his whole time. And so what happened was I watched the effect that it had on him, and it made me start researching. I got into business in 2003. I've been an advisor going into my 12th year, and I watched the effect that it had on him and some of the concerns that he had. So he was having a group in Ontario County, just like they have Rochester Works, they have Finger Lakes Works. And he said, Mike, you should come out to my group. We meet every Monday morning. It's a bunch of us, and I think it would be helpful if you just kind of randomly, not randomly, but talk in general about the things you've helped me with. So I said, no problem, I can do that. And I had no idea it would be a niche for me. I mean, most of the time as a financial advisor, if you tell people, well, my niche, I work with the unemployment office, people will look at you like you're a little strange because that's not usually where you think of a wealth manager. But what happened was I wound up having a niche where I found people that needed the help. And I was able to give it because I had a personal connection to it. So my goal today, guys, is to give you some practical information that you can use now. A lot of this stuff is geared towards someone who's worked somewhere for a little while. So some of it's about leveraging retirement accounts to fund health savings accounts. So there's a lot of different things that I'm going to talk to you about. Some potential tax deductions for the job seeker, because that's always important. And feel free to ask questions. We have a really big room with a really small group, so let's consider it kind of like an intimate meeting, even though we're all spread out. I always love that, too. You have a big room, a couple people, everyone grabs their own row. It's beautiful. I love it. So my group at Merrill, I've been with Merrill since '08, and just like all of you, I've been through job changes, so company changes. So not only have I been able to help a lot of people through it, either through my talks or directly with like a client, I also went through it personally. So I understand how difficult it is to change places. Now I did it, hey Larry, I did it of my own accord, but at the same token, any change is difficult. As human beings, we're not a huge fan of change. I've never heard anybody say, I love change, I just love it all day. It's just not how we're built. So my groups consisted of somebody who just graduated Nazareth, Patrick, and Melody, who's been in the business 20 years. And we've had the pleasure of working with Rochester Works. I've been a speaker for Rochester Works for 11 years now, and it's just been a great relationship because even the people that I never see again, we always strike up good conversation and are able to provide some relevance to the job seeker. So the first thing I'm going to talk to you about, because I have an hour, so I cut out a few of the slides, like on the market update and stuff like that. But the first thing I'm going to talk to you about is some potential tax deductions that the job seeker can get. So before I give you a whole slew of quasi-tax advice, I have to give you the disclaimer that I'm not a tax advisor, and to go talk to your tax advisor before taking any of my advice. Isn't that nice? So if you are itemizing, so here's some of the prerequisites for this, okay? You have to be itemizing on your taxes, so that's the first thing. So if you're taking the standard deduction, odds are none of this is going to really be very relevant. But if you're itemizing, some of this could make sense. So if your expenses exceed 2% of your adjusted gross income, then you can be able to write off job-related expenses, okay? So those are the prerequisites for the stuff I'm about to share with you. So the first thing, so for when you get arrested, no, I'm just joking. This is for if you have to use an employer-related attorney or a CPA or anything like that. Say you have an employment agreement or a non-compete agreement, and you go to an attorney to find out what your rights are. Or you have a 401k loan that defaulted, and you want to find out what are the tax ramifications, so you employ an attorney. or any of the above. So there's a million different scenarios. Vacation pay paid in 2 years, stock options triggered, whatever the case is. So any of that, just like in general, you can usually write off your tax prep fee on the following year. It's the same if you seek specialized services for any of those things. So from attorney to CPA to counsel. The more common one is mileage, because everything's so close in Rochester, right? I mean, pretty much if we don't have a car, it's pretty difficult to get around in Rochester. I mean, it's a bunch of suburbs, and a lot of the time, just like, how many people drove here today? Well, you're all still breathing, so that I would imagine you all did drive here because it's like negative 10 degrees outside. But in general, we're driving places, right? So we go to, how many people go to networking groups? How many people go to networking appointments? Right? Catch up with old coworkers. How many people hopefully go on interviews? All those things are job related. So a lot of the time, I have people clients or people that attend my workshops and say, well, Mike, you know, getting over 2% of my adjusted gross income, if we have $70,000 in adjusted gross income, that's $1,400. I don't have $1,400 in expenses. 55 cents a mile adds up. You know, nothing's really close. So if you're driving 10, 12 miles one way, 10, 12 miles the other, 20 miles another direction, it adds up. Having coffee, going to a networking group, anything employment related. And what happens is, typically, people wind up hitting the 2% limit by their mileage. Because there's one thing that there's no shortage of in Rochester, and that's mileage. Drive to Staples to get stationary cards, drive to Best Buy because you have to get a laptop, drive pretty much anywhere that's employment related. Keep track of it. And what I would say is do it within reason. Okay, so a lot of the time, anything you claim on your taxes, and this is just how it works in general for taxpayers, you can claim anything. If you get audited is where you're going to run into problems if you put something that's false. So don't claim 80,000 miles. You know, just do it realistically and be able to recreate it. So like I used to network and be close friends with an attorney who's no longer alive, but he was a great guy, and he kept all his mileage in a book in his inside lapel pocket. So he would actually, anytime we go anywhere, before we got out of the truck to go to lunch, he'd pull out this book and write down I mean, it was funny. That's the extreme. Where most of the time now, if you keep a calendar in Outlook or Google Calendar or on your iPhone or Android phone, you can pretty much recreate a calendar. And really, you know, it's within reason. There's, on IRS.gov, there's a 130-page PDF that talks all about all the potential deductions for a job seeker. So I just kind of took the most exciting ones and put them in 5 pictures versus 129 pages. Because everyone knows how exciting the IRS is, right? If you want to go to sleep, just go on IRS.gov, pick any publication, and you'll be asleep within 5 minutes. I mean, it'll relieve all of your sleeplessness if you have any problems from job search. So, well, we can provide some levity, right? So, internet. How many people use the internet to look for work? It's almost a given nowadays, right? When I first started doing this talk, even though I'm in my mid-30s, I started doing this talk when I was in my early 20s, the original deductions I had were nice stationery for resume paper, if you had dial-up, if you were converting your Roadrunner, because this was the stuff in the early 2000s. Nowadays, Roadrunners are given. A lot of people have data plans on their phone. Well, what if you got laid off and you didn't have a data plan on your phone, and now you had to get one to stay competitive? I would challenge a good portion of that as job-related. Get the LinkedIn app on your smartphone or on your iPad, okay? What percentage of your time are you using on the internet looking for jobs? So if you already had Roadrunner and you're spending $50 a month, should you go deduct $50 a month from your taxes? No, definitely not. But I would talk to your tax advisor and say, hey, I utilize this 20 to 40% of the time for job search. What's an allowable amount that would be acceptable to the IRS? I mean, these are all common things that people utilize. How about cell phones, iPads, updating your software? Going from Microsoft 1997 to 2008. Any of those things. So we have to dust off whatever we have to dust off, or get a new iPad, get a laptop, software programs, get a new iPhone. Any of those things, if you're in the job search, they're job related to make you more effective, more competitive. Those are all reasonable things that you can put on your taxes. That is if I was a tax guy and I was giving advice, but I'm not. but you get the idea. And finally, trade publications. How many people get the D&C still? There's a very small section in there called the want ads. If you blink, you'll miss it. But they do offer some jobs. So if it's job related and you're spending $30 a week or whatever it is, $30 a month, I would challenge you getting a job related. How many people belong to a trade association?
I was just going to ask you if that's applicable too.
They're always applicable. So if you pay trade association dues, whether or not you're in the job search, typically those are usually able to be written off. Okay, but definitely if you're in the job search. Now, here's another thing I would say about that. So I stood in this room probably 3-4 years ago, and they taped me doing the networking and referrals workshop. So I do one for job seekers. I'm also a national speaker for Merrill Lynch, the firm that I work for, in dealing with certain sales and marketing principles, and I put it back to the job seeker. And the reason I say that is because trade publications, it's like side advice, so I'll digress from the finance for a sec. Trade publications usually have meetings. How many people have ever went to their trade association meeting? There's a good chance that people at that trade association are employed, right? Typically you have your group of unemployed, your group of retired, and your group of working. It's a great place to network. I always like Wayne Gretzky's saying, he skates to where he thinks the puck's going to be, not to where the puck has been, right? So going there is something unique. Going there is something that you might be able to drum up some live business cards of people that are working that might have a direct inlay to something. So I highly recommend if you are in the job search and there is any trade publication that a trade industry group that you can join relevant to your industry, join it. Write the dues, it's tax deductible, and go to every meeting. It'll be a great way to get around people in your field. Okay? Questions on that? Okay, so if you get laid off and you get a severance package, so there's getting laid off. There's the official firm severance package. Hopefully it's more than a T-shirt. But in the worst professional year, and this has happened to many of my clients and many people I've met at these talks that I've given, you get a severance package, get unemployment, say you start working again in the same year, well, all of a sudden you're in a higher tax bracket than you've ever been previously. Well, that kind of stinks. In the worst professional year, you lose your job and wind up in a higher tax bracket. I had to do something to make you laugh today. So it is ironic, though, if in the toughest financial year or professional year, you wind up in a higher tax bracket. So what are some of the things that you could do to reduce your tax bracket? Well, the first thing is what I just discussed. So keeping diligent notes on your travel, on if you're going to get stationery paper, and that's another thing. So I'll weave in some of the networking stuff in there as I give you some of these points on the financial, but everybody should go to Staples, get some note cards. Go to paperdirect.com. You can get personal stationery made up very cheap. And that's a great thing. Send handwritten notes. I always send, how many people in the room remember the last handwritten note they got? How many people remember the last email they got? See, emails are so much more impersonal, and there's a million of them. But if you can get a tax deduction for it and then execute an effective networking strategy on top of it, it's really a win-win. So in addition to the potential tax breaks for the job seeker, the mileage, and all those things, let's say that you wind up in a position where you do have a surplus of cash because you got a severance package, unemployment, and maybe you started working, you got back vacation pay, whatever the case is. What can you do to minimize your tax bracket? Well, besides the write-offs, you may be able to make a tax-deductible contribution to an IRA. The other issue with that is how many people have transitioned from an employer to contract work? Okay, so one of the setbacks sometimes in contract work is that they don't offer a 401k plan. So now let's say that you're fortunate enough to get a job through a contract house, you're getting paid W-2, so you're getting paid like a regular worker, but you do not have access to a 401k plan. Well, you could fund an IRA, and that would minimize your taxable bracket. It works exactly the same as deferring into a 401k, except the limits are less. So with a 401k, it's $17,500. With an IRA, it's $5,500. Okay? So again, I'm not telling everybody in the room to go out and fund an IRA. I'm just saying that if you're at that rock and a hard place where you're trying to minimize your bracket, especially now because we're in January, taxes are going to be due for last year by April 15th, so you have up until April 15th to fund an IRA if it makes sense. The other thing I would tell you is check with your tax advisor because you may have made too much money to fund an IRA. Well, let me back up. You could fund an IRA, but to get the tax break, if you make over, I think it's, the phase out is between 95 and 115,000. So let me see if I can use this. I just discovered this tool. How cool is that? So 95 to 115,000. If your adjusted household income, if you're married, is above that or in that limit, you cannot deduct your IRA contribution. Okay? So, and that's why sometimes those commercials, here, I'll give you a little rant, like those commercials, Fidelity, of maximize your IRA, drives me nuts. You might not even be able to get a tax break for doing that. It all depends on what your tax bracket is, okay? But so just food for thought. Oh, I don't know why I did that. Okay. So what are some of the other things? Well, let's say that you're not as concerned with reducing your tax bracket, but you want to put some money away. And you don't have access to a 401, but you have earned income for the year. Earned income is the key. So to defer anything to a retirement plan, personal or corporate, you need to have earned income for the year or your spouse needs to have earned income. Okay? And that's where you can either do your own IRA contribution or a spousal. But say that you're not as concerned, but you want to save some money and you don't want to pay taxes, Roth IRAs are great for that. You can put the money in, you don't get a tax break now, grows tax deferred, and it's tax-free upon withdrawal. Here's the other reason why I like Roth IRAs and Roth 401ks. So the next job you guys get, if they have the Roth 401k option, I highly suggest looking at it for a portion of your deferrals. Why do I say that? Because the contributions that go in, while you don't get a tax break, they're accessible to you at any time because it's after-tax money. Because what's the biggest issue with an IRA or a 401k if you go to take a withdrawal and you're not 59 and a half? Penalty and taxable as income. So what happens is you turn around, you take out $10,000 from an IRA, you really need 13 to cover the federal tax and the penalty. Whereas in a Roth, there's no taxes or penalty. A lot nicer of a deal. So it's a tool that came out later. So especially for the younger people in the room, the more Roth you can do, the better. Because what happens is what we can't control in retirement are tax rates. Can't control them, right? So if you're retired and taxes go up 3% and all your income coming to you is taxable, what just happened to your income? It went down by 3% because taxes went up. So Roth is a good tool. Municipal bonds. Again, none of this is an investment recommendation to anybody in the room, but it's just giving you some ideas and concepts that might be able to help mitigate taxes that you're paying while you're going through the job search or in general. You have some money in the bank. Banks used to pay this thing called interest. I don't know if anybody remembers it. Nowadays, you walk in the bank, they have a picture of interest, RIP, things like that. So municipal bonds are tax-free bonds. They're not as conservative as cash. So the only thing that is guaranteed never to go down in value is cash. But on the risk spectrum, you have cash here and stocks here. Huge difference, right? So couple levels in from cash are municipal bonds. They're issued by townships. They usually fund projects. But you can usually own them in a mutual fund, and the interest derived from that's not taxable on the federal level. And if you have a New York State muni bond or bond fund, it's also not taxed on the state level. So even though the yield might be paltry, 2%, 3%, it's tax-free. So do you want to earn 3% tax-free or 0.1% taxable in the bank? So it might be something, not to put all your cash in it because it's a different asset class, but it might be something to look at. And finally, an HSA. How many people are on a high-deductible health insurance plan? Surprisingly, usually somebody in the room is. Nobody's on a high-deductible health insurance plan. Interesting. How many people are on an exchange plan, New York State Healthcare Exchange? Okay. So a lot of those are high-deductible. Yours is an HMO. It's not high-deductible. So a lot of people nowadays, too, with employers, what you see is as people work somewhere, the new plans usually are high-deductible. They're more and more common now, just because employers are trying to keep costs lower, and high-deductible plans allow them to do that. But the problem for the recipient is now you have a higher deductible to meet. So even though premiums might be a little bit less, you're faced with this higher deductible. But if you're eligible for a high deductible plan, now or in the future. This information is important because what you can do is you can fund a held savings account. And what's interesting about a held savings account, these are all the contribution limits if you need them. But what's interesting about a held savings account is a couple things. It's the only account that I know of that you could put money into an account and get a tax break and you don't have to be working to do it. Okay? So with a lot of people think, well, I have to be working to have an HSA. No, you have to be working to payroll defer into an HSA. The only qualifying event to have a HSA, held savings account, is that you have to be on a high deductible plan. So if you're a retiree from Kodak, all their plans are high deductible. Xerox, same deal. A lot of local places, or if you get on the exchange, same deal. Your eligibility window for HSAs end at 65. Once you hit Medicare eligibility, you can no longer fund the held savings account. Okay? So some of the benefits of why I really am an advocate for these, they're relatively new. But for everybody in the room, if you ever wind up in the position that you're on a high deductible plan, fund an HSA. And I'll tell you why. It's not like an FSA where you use it or lose it. You can keep it. So just like a car, as it gets older, parts break down. So as you get older in retirement, something might break down. You might need a new hip. You might need different teeth, whatever. Statistically, these are the things that happen. An HSA continues on, and it grows tax deferred, and the distributions are tax free. So it's a great tool to be able to have in the portfolio of your overall assets. So if you're on a high deductible plan or you eventually go on one, fund an HSA either through payroll from your savings. Now, if you're in a situation where you've been at a place for a long time and now you're unemployed and you're looking to fund an HSA but you don't have the cash in the bank, there's actually one way that you can do it from a retirement account. It's a loophole. It's perfectly legitimate. It's on IRS's website. But this bottom quadrant here, let me make it blue. So red always denotes like you did something wrong. Remember the teacher, they write in red on the paper? It was never good. So we'll use blue. So qualified health funding distribution. The IRS allows a one-time qualified health funding distribution, so that's a tax-free distribution from an IRA to fund the health savings account. Now, why is that important? The only way that I know of to pull money out of an IRA and not pay tax is to do that. There's no other way that you can pull money out of an IRA and not pay tax on it. So it's a pretty cool thing. And the other thing is a family contribution. So to go back for a second, whoop. She thought that was funny, see? So on the bottom here, single plan deductible, $1,300 maximum out of pocket, $6,450. Contribution limit for a single person in a held savings account is $3,350. If you're over 55, it's a $1,000 catch-up. Family plan minimum deductible, $2,600 out of pocket, maximum out of pocket $12,900. These are your expenses. Contribution limit $6,650 plus a $1,000 catch-up. So let me give you a scenario. Family, the person that's insured is 55 years old, has a family on a high deductible plan. That means in theory, they could fund the health savings account for $7,450 from an IRA and not pay any tax. That's a beautiful thing because it's not use it or lose it, and you're not parting with cash from your own bank account. So the difference is typically when you put money into an HSA, you get a tax break, just like an IRA. Put money in, comes off your taxable income. With a qualified health funding distribution, there's no tax break, but there's nothing taxable. So it helps if you're counting your non-retirement savings, stuff that's in the bank, but you want to fund an HSA, that's a great thing to do. And you can also pay pretty much everything, COBRA premiums, long-term care insurance premiums, medical expenses. So there's a number of different uses for a health savings account. So if you do wind up being on a high deductible plan, it's definitely not the end of the world, because you can utilize that. Questions on that? Inside your folder, and for the gentleman in the back, if you want a folder, I have them up here, because I saw you taking a picture. If you want, all the handouts are right there. So, and also in there is a fact sheet on a qualified health funding distribution. So it talks about what it is. It talks about what a health savings account is, just to give you guys that information, okay? Because a lot of the time when we go through a job search, information's important. And where to get it sometimes is hard, because it's not like this stuff. I think this talk is fairly unique in the sense that I haven't seen other people putting it on, because it's really been relevant to the person in transition that I've seen over the years and the things that they need. So, and again, these are just the specifications of a qualified health funding distribution. So, life insurance check. If you worked for a major corporation, you might have had group life insurance. The other piece is some of that might be portable. Well, why would that be important? If you have family, if you still want to keep your insurance, sometimes having the portable insurance from your employer makes the most sense because it's cheaper and you don't have to get proof of insurability from a doctor. Okay? So it's important that you check that. So if you're in the process of leaving a company or just recently left, check with your HR to find out the portability features of the insurance if you still have the need for insurance. Same for long-term care insurance, same for disability insurance. It's just cheaper if you can get it from the employer and keep it. Okay? And the other piece is personal life insurance. So a lot of the time, especially to my boomer people in the room, if you have those old Prudential, John Hancock life insurance policies from back when the earth cooled and they're 30 years old and have cash value in them, insurance is a great amount like televisions. As the years go on, they get cheaper with more features. So if you're in a position where you're in the job search and you might need access to some cash, doing a review of your old policies to see if you should be taking a loan, converting them into something else, utilizing the cash value, it's an important thing. You might be able to minimize the cost of what you're spending. Okay? So it's important to look at these things, I guess is what I'm saying. You never know what you can come up with, but never hurts to look. So keeping your goals on track. I've never had anybody after one of these talks come up to me and go, you know what, Mike, after listening to you, I've decided I'm never going to retire. It just doesn't happen. People still want to retire one day. Job change, job search, still at some point might not want to have to go to work. So want to keep those goals on track. And the main thing is that you don't want to make long-term decisions based on short-term feelings or short-term situations. So when we go through some of the things that we go through, an early distribution sometimes to make ends meet is unavoidable. But it's important to understand the ramifications of that, and it's also important to understand how you can best utilize the things that you have available to you if you've worked in a place for a long amount of time. So what this is the tax impact of an early withdrawal on any type of retirement plan if you're not 59 and a half. So $50,000 comes out. We'll donate 5% to New York State for their tax, 10% for the federal penalty, so it comes off the gross amount. Let's say you're in a 28% tax bracket, another $14,000 to the Fed, and you pocket 57% of the overall distribution. And you know what else happens? You phase out all the other potential deductions you have, because now your adjusted gross income just went up by $50,000. So that means you have to have an extra $1,000 of job-related expenses to even write those things off. So it's a compounding effect. And this happens all too often. Sometimes it happens not through your own choice. You had a 401k loan, you get let go, it defaults, now you owe money. So we really want to try to avoid this type of scenario from happening. So there are some ways to have penalty-free access to your own retirement accounts. So the reason I say that is if you need it. If you're in the job search, you have a previous plan somewhere, or you have multiple plans. I have clients that it's not uncommon to have 3 to 5 401ks, 2 pension benefits if they did the I Love New York tour, went through Xerox, Kodak, Harris. You know, it happens where we wind up going through a lot of different changes. So here's the ways that you can have some penalty-free access. The first are the 3 Ds, death, disability, and divorce. I don't recommend these, but this is how you can avoid a 10% penalty, okay? So the first is if you inherit a retirement plan. The 10% penalty is waived in death. It's also waived if you are deemed SSD, Social Security Disability. So if you're federally disabled, the 10% penalty is then waived. And also divorce. If you're going through a divorce and you have to assign out a portion of your retirement account or you're receiving a portion of a retirement account, it's not penalized. Separation of service at 55 years or older. This is an important one. So a lot of the time, if somebody's separated service from the company at 55 years or older, you have penalty-free access to your 401k right as it sits, okay? Which is important because you might need a bridge between now and your next job. Leaving all or a portion of your money in your 401k could be helpful because then you have access to it without a 10% penalty, Okay? Is that right for everybody? Maybe, maybe not, but it's important to know the rule. So any ex-Kodak people in the room? Okay, so Kodak, so sometimes the plans themselves have their own rules. So like, for instance, if you separate service at 55 years or older from Kodak, they allow for penalty-free distributions, but they only allow 4 distributions a year. That's a Kodak thing. That's not an IRS thing. So if you worked at Xerox and you left at 55 years or older, you could take a withdrawal every other week if you wanted and not pay a penalty. So it all depends on how the plan is set up, okay? The other one is substantially equal periodic payments. So this bottom one here, I want to touch on for a second, okay? So I'll give you a story. I always tell the story of my client, Danny. He was a Kodak person. He was there 30 years. He got laid off. I met him at Lehigh Terracin. I used to do this talk for Lehigh Terracin. And they're the outplacement service for Kodak. And he got a new job at J&J, Orthoclinical, which now went through another merger. But at the time, he said, well, let me ask you, by a show of hands, how many people feel the next job is going to pay more than their last job? I like her, the optimist, which is good. And there's a very good chance that is. If you're on your way up, starting out, for people that have been at places a longer amount of time, statistically, it's usually a little bit lower. So what happened with Danny was that he went from making X at Kodak to making Y at J&J. And he said, Mike, the only problem is my bills haven't changed. My mortgage payment's still the same. My car payment's still the same. The kids' college payment's still the same. I have this gap. What am I going to do? And so what happens is substantial, and he was 53. So this 55-year rule wasn't going to work. Substantially equal periodic payments are, it's a formula. The IRS has 3 allowable formulas, and what they do is they take your age, they take the account value of whatever it is. It has to be an IRA, it can't be a 401k, and they calculate what your penalty-free amount that you'd be able to take out each year from it. Here's the catch. 5 years of 59 and a half, whatever's longer. So if you're 52, that'd be 7 years. If you're 55, it's just about 5.5 years. If you're 45, this isn't a strategy you want to do because you'd have to take it for a very long amount of time, 14 and a half years. But for Danny, it was a perfect case scenario. He was 53. He needed extra money. So what we did was we allocated a portion of his IRAs to SEPs. We used an IRS allowable formula, and we were able, between his income from his new job and penalty-free, it's taxable but not penalized from his IRA, he was able to sustain his living. Okay? So something like that, guys, is important if you're in the job searching and you think your next job is going to pay less and you want to offset your income, but you're not 59 and a half, this could be a very viable strategy. I included a fact sheet on it in there. But there's risk with it. So if you start taking income early, how does that affect your income later? How does it affect your net worth? How does it affect, a number of different things towards your goals and what you're looking to do? And also, if you're a very aggressive investor and you decide you need income, income-producing investments are very different than growth investments. The bond market's 3 times the size of the stock market, and it's 10 times harder to understand. Most people understand stocks, right? They go up, common stocks, yeah, I get it. How about bonds? Way different. Duration, there's a million different terms with bonds. There's 19 different types of bonds. You have government bonds, corporate bonds, foreign bonds. You have bonds called strips where they strip the interest out. You have tips that it's just inflation protection. You can write a nursery rhyme with how many different bonds there are. And unfortunately, they're way more harder to understand, so people tend to shy away from them. They just know bonds are boring, or they go down in value, or whatever the case is. But unfortunately, you need a big component of that if you're going to take income. Because stocks, even though for the last 5 years have been straight up, how many people remember 2008? How about 2000? They can go down. So it's important to have a protection strategy in there. And I think sometimes the news forgets what happened years ago. What do they say? If you forget, you're doomed to repeat. So qualified distributions. You essentially have 3 options when you leave an employer. So the first is you keep the assets with the old employer. Well, it's kind of like that old girlfriend and boyfriend in high school. You didn't really like him, but you stayed with him because you knew him. So it's kind of familiar. So a lot of the time people leave a place, they keep their plan with their employer just because they don't know any different. They know that plan and they're familiar with it. I would challenge all of you in the room that a lot of that is an emotional reason versus a logical reason. I'll give you a great example. Met with a CPA. You'd think CPA, pretty savvy financially, right? I said, well, what would you consider yourself an investor? He goes, oh, I'm very conservative. I said, okay. He goes, now you're going to think I'm crazy. I said, well, why is that? He goes, well, let me show you my 401k. 100% stock. He goes, I know. I said, why do you own 100% stock? He goes, here was his reason. I'm familiar with this fund. I've had it for 20 years. That's not a logical answer. It's an emotional answer because he was familiar with it. So what I study a lot is behavioral finance. People make their decisions with money based on emotion many more times than logic. So think about that because you might have better options in your own IRA. 9 times out of 10 you do. You can do more with the investments. You can do things like SEPs. You could set up your contingent beneficiaries more elaborately than you could on a 401k if you have anything like trusts or anything that you want to utilize. So there's just a lot more things you could do with it, and you have a lot more investment opportunity inside an IRA than you would a 401k. So, but these are the reasons why some people leave it in their old plan. So distribution options. How many people like my rollover picture? So typically an IRA rollover is a better option to do unless there is a specific reason not to. So some of those reasons might be you're 55 years old and you can avoid penalty by leaving some or all of the funds in a 401. You have a 401k loan that you can still pay back even after employment and you don't want to default it. So those are some reasons. Kodak, Xerox, they used to have what's called a stable value fund. It paid a fixed rate of interest. Since interest rates have been down, they did away with those funds. So those aren't really even a reason now to leave the money at that plan because they don't exist anymore. So 9 times out of 10, an IRA is a better option. So the advantages, you continue tax deferral of the tax-deferred growth, increased control of beneficiaries, a wider array of investment options, professional management if you use someone like myself. If you do it on your own, you have your own options from a million different things out there in the investing universe. Also, qualified health funding distribution, what we spoke about with an HSA. You can only do that from an IRA. You can't do it from a 401k. Okay, so, and that's the IRS rule. And you can stretch an IRA down multiple generations. That's something you can't do with a 401k. So if you have a 401k, you leave it to your kids, something happens to you, they have to then go out, find an institution to create an IRA, and pray that the 401k provider sends the check correctly so nothing's taxable, and then they put it in an IRA. It's a lot easier and fluid if it's already in an IRA. So here's the risk to an estate. Bill and Amy are 54 and 53. Bill has a 401k balance of $350,000. He had children, but he started working there at 19 and just never got around to updating his contingent beneficiaries. Or they changed providers and they were never mapped over. I've seen that happen too, where you work one place. How many people ever got that notice that they changed custodians on a 401k plan? Happens very often usually. You work at a place, provider's Fidelity, the next week it's ING. Okay? And that happens. And what happens sometimes is that some information doesn't get mapped over. So if you have it where Bill is the primary, he has a $350,000 401k, and Amy is his wife, she's the primary beneficiary. The kids would inherit the money if something happened to them, but they're not named contingent beneficiaries. What happens is, if Bill and Amy were killed in an accident or something, that $350,000 would go to the surviving kids, taxable as income to each kid. So it's important to make sure that all your beneficiaries and contingent beneficiaries are up to date. The other issue is with a 401k, if you leave an employer and you have a 401k there and it's sizable, you're doing yourself a disservice because you're not getting a specialized number for service. So the person that's just starting out calls the same number you do. If something happens to you, you're praying that your family gets a competent person on the 1-800 number. That's a risky bet sometimes. So this is the concept of a stretch IRA. Bill's same scenario, 54, 53, $350,000 IRA. The kids are contingents. What happens is, if they were to die unexpectedly, each child would have an inherited IRA that they would stretch down. And they could stretch that down to multiple generations as well. Okay? A lot more sounder way to do it. It eliminates out some risk. Okay? So I know it's not the primary thing you guys are thinking about as you're doing a job search, but it's important to look at. A lot of the time also I hear from people, well, I'll look at my finances after I get a job. And again, some of that could be an emotional piece, because think about it. Would you be in a better financial position to negotiate for a job, knowing your bottom line, knowing your cash flow, knowing your net worth, knowing what you need to retire on, versus not knowing? Okay, so I would say to anybody in here, as you go between your job search, think about that. Make sure you have some sort of organized plan, that you actually look at what you want to do, and that you have some way to statistically track it. Because it's important, especially as you go through. So I included this chart for you guys. So based on your age and based on the type of plan it is, so an IRA is just as it says, an individual retirement account. A qualified plan is any 401k, 403b, anything like that. But it tells you essentially how you would have access to it and if there would be a penalty or taxes. Okay? So for all you in the room, you're all different ages. So each thing will have a different relevance to the person looking at it. So in closing, guys, in turbulent times, it's critical to manage your resources holistically. And what I mean by that is usually a consolidation makes sense. So you can see everything in one place, almost like a bird's eye view. It helps you understand what you own. It helps you to be more effective, and even in a job negotiation, because then you know kind of what you're working with. In most instances, I'd say rolling over a 401k to an IRA gives you the control versus the employer, and that's always better. I mean, it's always in your name, but having it in your own name in an IRA usually gives you more control. And in closing, some of the questions you might want to ask yourself: how much will I need in retirement to maintain my retirement living standards? If I can get my computer to work, I'd ask you other questions, but it doesn't seem to want to do that. There we go. What are your goals? How well have you done? How is the layoff going to affect it? What's your bridge strategy? So a lot of the time, if we're going in between jobs, it's important to look at your assets holistically and figure out what your bridge strategy is. How are you going to get from point A to B while you're looking for the job search in the best way tax-wise and the best way investment-wise, that you're not going to kill your future plans by accessing things now. And what are you doing to monitor your situation? You know, if you're starting out, it's a little bit easier because there's not a lot to monitor. You're really just looking at getting the best job. But for those of you that have been in the job search and have been in a place for a longer amount of time, it's important to look at how you're monitoring the situation holistically. So hopefully this was helpful. If you guys have any questions, please let me know. Yes?
You were mentioning the health savings account.
Mm-hmm.
Which institution can we get that from? And do you have any suggestions?
Tons of them.
Okay.
Tons of them. So if it would be on your own, it depends on where you bank. So sometimes banks offer them. If you have a financial advisor, typically the firm that you work with, they'll have them. You can open them up online yourself. So if you're more of a do-it-yourselfer, like online, like how they have like ING online savings, typically you can find an HSA online as well. So a number of different sources. The only time you're bound to a particular institution with an HSA is if you're working somewhere and they offer a health savings account. Because typically then they'll payroll defer. If you payroll defer, you have to use the institution of choice for the employer. And then typically they'll match. They'll throw some money in it. And what I always tell clients and people that attend my workshops is if someone's willing to match your money, there's a lot of things I can do with your money, but putting in my own money ain't one of them. So if an employer can put in some money in your health savings account or match your IRA or match your 401k, they don't match IRAs, then by all means utilize it. Hopefully that answers that. Any other questions? Yes?
When you were mentioning an inherited IRA,
Mm-hmm.
there was an acronym RMD.
Mm-hmm.
What was that?
Okay, so RMD, what that is the IRS basically says an RMD is a required minimum distribution. Okay, so for an individual, when they reach 70 and a half, the IRS, like any good loan shark, says we want some interest. So like I grew up in Queens, so like, you know, like you remember they talk about the mafia in the 80s and 90s, so loan sharks are the people that would lend you money and charge a lot of interest. So the IRS, like any good loan shark, says, okay, at 70 and a half, you have this tax-deferred account, you have to take some money out and pay taxes. The difference with an inherited IRA is that the required minimum distributions they can start younger. So for instance, say your grandmother left you an IRA. When she would have turned 70 and a half, so if she was already 70 and a half and you inherited it, you'd have to take required minimum distributions out on that for the rest of your life. So the IRS has a formula for everything. Okay, so they have RMD formulas for individuals, for spouses, and for non-spouse beneficiaries. Okay, so, and if you miss it, and this is very important, if you have an account that you're supposed to take an RMD from and you miss it, it's a 50% tax penalty. So if the RMD is $3,000 and you miss it, you have a $1,500 tax penalty. I told you they were loan sharks. I'm just joking. So, any other questions? Yes?
Any tips for monitoring your retirement goals?
Well, it depends. So for people that are do-it-yourselfers, you know, nowadays they have a lot of programs online that they can do. If you're working with a professional, they should be doing that. They should be monitoring it. There's a lot of different financial planning programs out there. Like we use one that does statistical, it's called a Monte Carlo analysis. So it'll take your scenario over 1,000, it'll take your plans over 1,000 scenarios to see what probability of success you have. What I always tell clients is it's good to have somebody objectively review your stuff. Because like it would be hard to perform surgery on your own arm. You know, we have a lot emotionally invested in it. And it's the same with finances, where sometimes it's helpful to have an objective person look at it because they might have seen something that you didn't see because it's not something that you work with regularly. Good questions. Good questions. Anybody else? Or you, if you have any other questions? Hey, I'm happy to answer them. All right, guys, thank you very much. Good luck out there. Have a great day today. Hopefully this was worth your time. I appreciate it. Thank you very much.